Mark Matthews, Head of Investment Research at Julius Baer, now joining us live. Good morning. Well, you can see there's only one color across the screen. It's red. Back home for the Nifty, only one stock that's in the green, which is ONGC. Everything else in the red. My first question to you is, how are you navigating through this uncertainty thanks to geopolitical tensions? Are you seeing this as an opportunity, or are you using this as a time to take cash off the table?
Well, typically geopolitics don't feature much in markets. Once in a while they do. I mean, if you look at when Iraq invaded Kuwait in 1990, that resulted about in a 17% fall in the stock market, and it took quite a long time to recover after that too. And so with these kind of very localized things, I really hesitate to provide a lot of insight because I don't have any, and they're such complex situations in their own right. I mean, if you tried to explain Kashmir to an outsider in 30 seconds, you wouldn't get very far. And I can't do the same with Ukraine. I don't know much about the situation. What little I do know is that Putin has chosen to express his support for this semi-autonomous region, Donbass, in the far east of Ukraine, where the majority of the people are Russian speaking. And I doubt that the Ukrainian armed forces will want to directly confront the Russian armed forces for the simple reason that they know they will not be given hands-on support by NATO. European countries and the United States don't want, I mean, the polls are showing the people in those countries don't want to send troops or to get very involved in this issue. So I can't tell you when it peaks in terms of the way it impacts sentiment, but I do think that a month from now, it's highly unlikely we're still going to be talking about it as much as we are now.
So given the fact that you think that in a month from now, maybe this event will not be taking center stage, how do you plan to cross this month with respect to the markets?
Well, I don't think there's much sense in doing a lot in portfolios purely on the basis of Ukraine because, number one, the outcome is highly uncertain. Number two, I personally don't think it is going to escalate into a real hot war. I think it's simply a representation of the fact that the world is polarizing, splitting into blocks, and we are going into, well, we've probably already been in it for some time, a Cold War, which is unfortunate, but the markets did well throughout the Cold War with the Soviet Union. I think they can do well in this situation. And then I suppose to try to put a positive spin on it, it is something that the Federal Reserve could point to say we don't need to be as hawkish as we were planning on being before, or at least we won't be as hawkish as we were planning on being before. I struggle to see rates going up a lot with this kind of thing in the background.
3 months from now or 6 months from now, if we will remember and talk about this ugly patch of global volatility, Feb 2022, in hindsight, do you think this will be like a blessing in disguise for a long-term investor? Is it time to correct your regrets and buy all those stocks which you wanted to buy but you never got a chance to buy?
I suppose it depends on how much the market goes down. If it goes down 20%, I would say yes, but otherwise, I was eavesdropping on your conversation earlier, and it's true that we haven't really come off very much. I mean, on average, since 1980, the intra-year decline of the S&P is about 14%. So, I mean, I think we're sort of at around 8% now, which is even below the average. So I don't think 8% decline from the peak after the kind of bull market that we've experienced for the last few years is a buying opportunity, no. But maybe another 12% would be.
Mark, are you saying we're going to fall further 12% from here?
No, I'm not. I don't know, but that's where I think people start to get interested in stocks. At this level, I just don't think it's gone down enough.
You know, Mark, what's fallen and really took it on the chin has been the new age listed tech startups, your Nykaa, Zomato, Paytm. I don't know how familiar you are with these names, but it's really these new age technology startups which have taken a hit along with, some of the IT names in the US listed in the NASDAQ. There's no correlation, but it's pretty much been a synchronized fall that we've seen back here in India as well. Is that the space really to look out for, or would you say the tide has now changed from these new age internet companies?
Well, there's no doubt India's in the midst of a digital renaissance, and that will be very profitable for many companies. And you'd have to, I think, do your due diligence on each one to understand which ones are going to be profitable if they're not already within not too far in the future. And that's the thing, is that we are entering a rate hike cycle. There's no doubt about it. And I don't think it will be as strong as the futures market is implying or investment banks are forecasting. But when rates go up, those kind of super long-term earnings are less valuable. And so I think there probably are some babies being thrown out of with the bathwater. And it is worth doing those kind of screens. I agree with that.
Okay. Mark, if I look at the relative comparison and even an absolute comparison, the India long-term story and the medium-term outlook has a differentiated spiel to it. It's got a different appeal. So if the India story, which you always have advocated, is strong, why are Indian markets getting such a stepmotherly treatment from foreign investors? The outflows, if I look at the total kitty of outflows in last couple of months, I've been told that it is higher outflows than what we've seen, which happened to Indian markets after the GFC crisis.
I'm not able to explain it. It's a bit of a mystery because Southeast Asia, for example, or Hong Kong are actually up this year, and so I don't know why India would be down, because it does have a very good story in my opinion. I suppose that simply because it went up so much last year, people would rather buy the big laggards, and certainly Southeast Asia, and Singapore and Hong Kong were much bigger. They were big laggards last year. But the other thing that struck my mind was perhaps a lot of that selling is passive in ETFs, which are emerging market or Asian ETFs, and so people are just saying, well, I don't want to be in emerging markets as a whole or Asia as a whole, and they'd probably be thinking mostly about China, and not even probably that aware that they have much exposure to India. But I can't explain it. All I would say is I think it's a great positive, because if we are going into a rough patch for the U.S. market, then I think one good thing about India is that foreigners are not loaded to the gills with Indian stocks like they were in 2008. And so I don't see a lot of pent-up selling from foreigners, because I think it's largely taken place already.
The markets don't react to the same news twice, right? That's what they say. Mark Matthews, the last time we had you folks on the channel, you all were overweight on India. You said it doesn't make sense to do portfolio changes based on Ukraine. But given all of the uncertainty, the volatility, we have to still watch out for the US Fed meeting mid-March. Are you still overweight on India?
Yes, I think there's a bunch of things to say. But probably in the interest of time, the most important is that India is in the middle of a economic upcycle, and that is something that it hasn't experienced for many years. So I think up until around 2020, the previous 10 years were ones of very subpar economic and earnings growth because of a lot of things: the non-performing assets in the banks, the structural reforms like the GST and bankruptcy court, etc. And those are now in the rearview mirror, and if you combine that with the digital renaissance that I mentioned earlier, I think it's a very exciting economy to be in, and that should be reflected in above par earnings growth over the next 1 or 2 years. Actually, I would take that back. I'd say 2 or 3 years. I would expect earnings growth of about 20% per year. So that one reason makes me committed to the Indian market for the foreseeable future.
I'm going to take a leaf from what Nikunj asked you a few minutes ago, where he talked about how you would see Feb 2022. Will February 2022 also maybe be the best buying opportunity when it comes to the equity markets?
Well, there aren't many days left in this month, and so if we somehow go down, 15% between now and the end of the month, then I would say yes. But in the absence of that, I don't think we have gone enough to make it, quote unquote, a buying opportunity. So it really depends on the magnitude that it drops. But I do think that the more time goes by from the all-time high, the more the momentum in the market does start to change and become less positive. And psychologically, people start to think, well, maybe it's not the big bull market that it was before. It doesn't mean it turns into a bear market, but that psychological impact of the market just sort of doing that might end up meaning that not just for India, but the world, 2022 is just a churning sideways year. I don't see why it should be a very big down year. And the biggest reason I say that is that I personally think inflation is peaking, even if oil prices are high. And I think, therefore, the magnitude of the rate hike cycle in America will not be as strong as the market is predicting. And if that's right, then I think that takes away a lot of the pressure from the market. But the psychological damage has definitely been done, and earnings growth in America will probably only be in the sort of mid single digits to high single digits this year. That, just to come back to India, is probably why it looks quite good, is that India will have much higher earnings growth this year.
Right. So, Mark, are you saying that for investors who've clearly been shying away from inflation-sensitive stocks and sectors, at least here in India for the last 2 to 3 quarters, they need to perhaps start nibbling if your view is indeed that inflation could be peaking out soon?
Well, intuitively, it would, wouldn't it? You're right, and I do notice in the surveys of fund managers that they have their largest overweights relative to the average of the previous decade in inflation-sensitive sectors like banks and commodities and energy. They have their largest overweights in those sectors. So I suppose that the issue is that rates will go up, and how much more is yet to be priced in. I think it actually boils down to each place. Like I would say, if I look at the miners, they're trading at all-time highs. Maybe not them, but then European banks. I think actually they could go up quite a bit more based on what we think that bond yields will be in Europe 12 months from now.
Mark Matthews, good to talk to you today. Thank you so much for joining in and giving us that perspective on your thoughts on not just global but Indian equities as well.